Welcome to another edition of The Explainer. I'm really thrilled you're joining me today because we are going to do something a little different and honestly, highly rigorous. We're putting a company through what I like to call the valuation gauntlet. Today, we're testing XPRO Group Holdings, ticker symbol XPRO, against the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And after that, we're going to run our very own discounted cash flow models. We are stripping away all the market noise to see exactly what the raw numbers and these classical investing philosophies are actually telling us. Okay, let's dive right into this. Here's our roadmap for today's explainer. We'll start with the XPRO Group company snapshot, then move into the Buffett and Lynch lenses, followed by the Benjamin Graham lens. After that, we'll hit our DCF valuation model, check out a few other valuation models, and finally wrap it all up with our synthesis and final verdict. Section 1. XPRO Group company snapshot. Establishing the baseline. Before we crunch the numbers, we have to know what we're actually buying. XPRO Group is a major global player in the energy sector, specifically hyper-focused on well flow management and managed pressure drilling. They do a lot of their work in international and offshore oil and gas projects. But what's really fascinating here is that they aren't just relying on old-school drilling anymore. They're actively transitioning. They recently announced they're acquiring Enhanced Drilling, which is a leader in next-generation managed pressure tech. Plus, they are making some massive strides in sustainability. They've already achieved a 28% reduction in Scope 1 and 2 emissions from their 2021 baseline, and they're targeting 8 to 10% of their revenue that come from non-core energy transition projects by 2026. So it's a legacy business trying to pivot. Let's look at their current baseline financials straight from the latest data. XPRO is trading right around $16.46 a share, which gives them a market cap of roughly $1.86 billion. They're pulling in a massive $1.61 billion in trailing 12-month revenue. But full disclosure, it's really important to note right off the bat that this revenue actually represents a 12.5% year-over-year decline. The offshore market is incredibly cyclical, and XPRO is navigating a period of lower, though highly predictable, growth right now. Keep that $16.46 price tag in the back of your mind as we start running our tests. Section 2. Buffett and Lynch lenses. Quality, moats, and growth. If the Oracle of Omaha, Warren Buffett, were looking at XPRO today, he'd pull out his classic checklist. First question, does it have an economic moat? Well, in the highly cyclical oil and gas equipment services sector, moats are traditionally pretty narrow. So that's a fail. What about a high return on equity? Buffett absolutely loves to see an ROE consistently above 15%. XPRO is currently sitting at a really low 2.41%, which basically reflects their current investment phase and pretty thin profit margins. That's another fail. But look at that bottom row. Manageable debt. XPRO boasts an incredibly strong balance sheet with a debt-to-equity ratio of just 0.10. It's practically bulletproof. Buffett would definitely love their conservative financing. But ultimately, the lack of a strong moat and that low ROE would almost certainly keep this out of Berkshire's portfolio right now. Now I want you to look at this single number, 92%. This represents XPRO's massive institutional ownership. Wall Street giants, think Vanguard, Dimensional Fund Advisors, they own nearly the entire float of this company. So why does that 92% matter to us? Because Peter Lynch, the legendary manager of the Magellan Fund, actively avoided stocks with heavy institutional ownership. He loved those hidden under-the-radar plays. If we apply the rest of Lynch's framework, he would likely categorize XPRO as a stalwart or a slow grower, because they're transitioning to those stable, long-cycle offshore contracts. But here is the real deal-breaker for Lynch, the PEG ratio. Let's do the math real quick. If we take XPRO's forward PE ratio of 15.39 and divide it by their projected 2% revenue growth rate, we get a PEG ratio of roughly 7.69. Lynch famously wanted a PEG ratio below 1.0. That tells you you're paying a fair price for the growth you're actually getting. At 7.69, you are paying a massive premium for very, very slow growth. So despite that bulletproof balance sheet, Lynch would rate this a hold or just an outright avoid. Section 3. Benjamin Graham lens. The margin of safety test. Benjamin Graham is basically the godfather of value investing, and he was completely ruthless with his math. He sought a hard, tangible floor for a stock's price. He popularized this legendary formula to find intrinsic value. You take the square root of 22.5, multiply it by the earnings per share, and then multiply that by the book value per share. That 22.5 is just a base constant Graham used. It represents a PE of 15 and a price to book of 1.5. So let's plug XPRO's numbers into this machine and see what spits out. Here are our inputs, straight from the latest data. Their Q1 reported earnings per share is $0.21. Now, book value per share wasn't explicitly listed in our baseline data, but as analysts, we can derive it pretty easily. We just take the current share price of $16.46 and divide it by the reported price-to-book ratio of 1.23. That gives us an assumed book value per share of $13.38. And of course, we drop in Graham's multiplier of 22.5. And wow, this brilliantly illustrates just how demanding Graham's framework is. The square root of 22.5 times $0.21 times $13.38 gives us a Graham intrinsic value of exactly $7.95. Remember, XOR's currently trading way up at $16.46. That means we are looking at a severely negative margin of safety. According to this strict formula, the earnings and the hard book value simply do not support the current share price. So for defensive investors strictly following Benjamin Graham, this is a glaringly clear sell or void. Section 4. DCF Valuation Model, Forecasting Free Cash Flows. Okay, let's move away from historical rules of thumb and build a forward-looking discounted cash flow model. A DCF forecasts the cash a business will generate in the future and discounts it back to what it's worth today. Based on consensus estimates, we're building our base case DCF with 4 key steps. First, we're projecting a modest 2% annual revenue growth, which reflects their shift to those slower growth, long-cycle projects. Second, we assume 10% operating margins, since management is really prioritizing operational efficiency right now. Third, we apply a 16x exit PE multiple. And finally, we discount those future cash flows back to their present value. Now, nobody actually has a crystal ball, right? So any good DCF model requires a sensitivity table. This shows us how our fair value changes if we just slightly tweak our assumptions. On the left side, we're varying the weighted average cost of capital, the WACC, which is essentially our required rate of return or discount rate. Across the top, we vary the terminal growth rate. Notice that if we assume a higher 11% discount rate and a sluggish 1.5% terminal growth, the fair value drops to $18.50. But if we're feeling highly optimistic with a 9% discount rate and 2.5% growth, the value jumps up to nearly $25. But the crucial point is right there in the middle of our table. Our base case DCF model yields a fair value estimate of exactly $22 per share. With the stock currently trading around $16.46, this forward-looking model implies roughly a 23% upside. That is a massive contrast to the Benjamin Graham valuation we just looked at. The DCF is essentially arguing that the future cash flows are worth much more than what the market is currently pricing in. Section 5. Other valuation models, comparative multiples. Let's sanity check our DCF by looking at some comparative multiples. And honestly, these metrics give us a fascinating, completely mixed signal. The EV to EBITDA ratio, which is enterprise value to earnings before interest, taxes, depreciation, and amortization, is sitting at an extremely low 6.27x. That strongly suggests the company is undervalued relative to its core earnings power. However, their forward PE of 15.39x suggests they are fairly valued, pretty much right in line with industry averages. Meanwhile, their price to free cash flow is trading at nearly 21x, which looks quite overvalued. But we need context here. This slightly elevated cash flow multiple follows a quarter where they took a $20 million hit from unfavorable working capital changes, mostly linked to timing and geopolitical events in the Middle East. And if we look at that EV to EBITDA multiple historically, we see XPRO consistently trades at a discount. In 2024, it was 5.62x, in 2025, it was 5.37x, and currently, it's 6.27x. So why do they trade at such a low multiple compared to larger industry peers like SLB or Halliburton? It really comes down to their specific profile. Halliburton has massive exposure to the fast-moving, short-cycle North American shale markets. XPRO is heavily weighted toward international and offshore markets. Those are incredibly stable, sure, but they are much slower growing. The market basically discounts them for that lack of explosive growth, but rewards them with a stable, albeit lower, baseline multiple. Section 6. Synthesis and Final Verdict. The Master Summary. Let's walk through this master synthesis together, because the contrast across the board is just stark. The qualitative guru lenses, Buffett and Lynch, are telling us to hold or avoid. Exxon simply doesn't have the high return on equity Buffett demands, and the growth is way too slow for the premium price Lynch would want to pay. Benjamin Graham's ultra-conservative hard asset formula absolutely screams sell, pegging intrinsic value at a lowly $7.95. But then, we look at the forward-looking models. The DCF projects a fair value of $22, which is a clear buy signal implying 23% upside based on highly predictable future cash flows. And the comparative multiples place fair value comfortably in the $16 to $19 range. So what is the actual story behind all these conflicting numbers?
Really, it comes down to a battle between historical constraints and future stability. XPRO's fundamental strengths are undeniable. They have that bulletproof balance sheet with virtually zero debt, and they are successfully transitioning their business model to highly stable, long-cycle offshore contracts, all while making excellent progress on their sustainability goals. But the risks are very real too. They just posted a 12.5% year-over-year revenue decline, a slight Q1 net loss of $1 million, and they obviously remain highly sensitive to global macroeconomic slowdowns and geopolitical conflicts. Taking all of this into account, our final verdict for XPRO Group Holdings is a blended hold, leaning toward a cautious buy for investors who are seeking stability over explosive growth. While our forward-looking DCF models show genuine upside to $22 based on their margin expansion and cash flow generation, the strict historical frameworks of Buffett and Graham demand a much wider margin of safety. If you want to invest strictly alongside the philosophies of the legends, you'd likely need to wait for a broader market pullback to drag XPRO down into the mid-$13 range before pulling the trigger with real confidence.
And that brings us to the ultimate question for you to ponder. Are you a forward-looking cash flow investor, or are you a strict margin of safety value investor? The quantitative models show a clear $22 upside, but the legendary gurus urge a lot of caution. So at what exact price does XPRO trigger your buy criteria? Weigh the numbers, apply the frameworks we talked about today, and make your call. Thank you so much for joining me on this deep dive through the valuation gauntlet on The Explainer. I'll catch you on the next one.